Mr. Obert was consultant with McKinsey & Company, working in the energy, materials, and wholesale banking sectors. He holds a diploma in industrial engineering as well as a doctorate degree from the University of Karlsruhe in Germany and an MBA from the University of North Carolina, Greensboro, in the United States. So please join me in welcoming on the stage Matthias Obert.
Thank you, Michael. Good morning, everybody. Thank you for this opportunity to talk about Singapore Exchange's newest product in commodities, which we will launch later this year, electricity futures. I'd like to talk to you about this market, which is the first Asian electricity futures market. I'd like to talk about the benefits that the consumers and the industry overall will derive from it. And we'll also talk about how liquidity will be promoted on this market. So let's get right into it. If you look at Singapore, Singapore is a relatively small electricity market by itself. It's an island, but it's well connected. So if you compare it to other markets in the world, here, it's actually the smallest market that will have an electricity futures market. It's about the size of New Zealand here, at 42 terawatt hours a year. So why do we start a market here? Singapore actually has had a very successful physical power market for 11 years now. It's in electricity market company EMC, which is a subsidiary or partial subsidiary of SGX, which has been operating this half-hourly auction market for the last 11 years. And we thought it was time to launch a baseload future contract on this spot price. This will be launched on the 1st of October this year. Of course, all subject to regulatory approval still. Because of the size of the market, the product will also be relatively small. It'll be 0.5 megawatt hours in size. It'll be 2 years forward initially. And we have 5 Singapore generators preparing to be market makers on this market, which represent the major players in this market. So it's Keppel, it's Power Seraya, it's Tuas Spring, it's Sembcorp, and it's Senoko. So what will be the benefits that this market brings, or that we hope this market brings to Singapore, to its consumers, to its large consumers, and to the industry itself? We go down the value chain. For the power generators, which have actually initiated this market and have chosen SGX as the exchange of choice for this market, they are hoping to hedge their electricity production forward with it, so smoothing the cash flows that they receive and reducing market risk for their production. And it also helps them to dispatch power plants when it's cheaper to produce than to buy, and otherwise to buy from a competitor or through the market. We then move on to sales. We think that with the help of this future product, it will be easier for new retailers to enter the market because they don't have to build a power station before they can sell power to their consumers. And also offer new products to contestable customers. Which brings us to the benefits for the contestable customers. As you may know, Singapore doesn't have a fully liberalized retail market yet, but there's a certain threshold which will be dropped in the future, above which a consumer can buy from the market, which we call contestable customers. These contestable customers with the futures market in electricity will have a choice of supplier, which will promote competition. They will have more product choice, so moving away from the traditional oil index contracts, they might have a choice of fixed price or just lock in the forward price for electricity. And the forward price curve is, of course, a public good. The forward price curve in Singapore will provide an executable forward power price. So consumers can time their hedges and time their procurement. They can decide when they like the price and lock in their power price for the future. A bit of marketing. Why is SGX the best place for this, and why was SGX chosen by the industry as the market operator for the electricity market? SGX, as I said, is already in the physical market through EMC, but SGX also offers the broadest range of other energy derivatives here, which gives the users of our electricity futures the hedges for their fuel. So we offer the Singapore heavy fuel oil, we offer the other oil products that they need to hedge their fuel leg. So as I said, when we start this market, it's going to be a small market, so you have to ensure liquidity. How do we do this? It's basically 4 items. The first one is we chose a very simple product structure to concentrate the liquidity in the few products that we list. So the initial product that we list will be base load, futures, and quarters only. We will go out 2 years as well as the front contract. So you will have 9 quarterly contracts at any point in time, which concentrates the liquidity instead of dispersing it into, say, months or peak products, etc., which may come at a later stage. The second one is that we have industry market makers, the companies that I mentioned earlier. 5 Singapore generators that are preparing to be market makers in this market, which increases the buy-in from the industry. It increases the sophistication. It increases the knowledge in that market. It also increases their willingness to use this market and to participate in it for hedging reasons. And we believe that other generators and industrials will also hedge through this market. We have received a lot of interest from those not participating as market makers as well as from industrials to play actively in this market. And the third point is the small product size. 0.5 megawatt is actually much smaller than you would see in other markets. If you look at New Zealand, the customary size is 1 megawatt. If you look at Europe, for example, EEX, you would trade 5 megawatt blocks. It's not possible here because Singapore by itself is relatively small, size of New Zealand, although it's interconnected. So with a product size of 0.5 megawatt, this product will be attractive and useful for industrial size energy users, of which we have many in Singapore. And the fourth point is the link to the other SGX commodity products. As you see, SGX offers, apart from electricity, later this year offers a comprehensive suite of oil products, coal, iron ore, freight, metals, and rubber. The most important one for this purpose being oil, because all the gas supply in Singapore is indexed to oil in some form or another. It's either Brent or it's heavy fuel oil. And generators will need to hedge that generation leg, that fuel leg of generation when they hedge the electricity. With these oil products, we will offer margin offsets, which gives users of this market margin efficiency and makes this a very efficient and effective hedge tool for the industry and for electricity buyers. So electricity futures, yes, it's a relatively small market, it's a relatively small product initially, but what does it mean for Singapore overall, and what does it mean in the Singapore context? Quoting the International Energy Agency in this red box here, Singapore is actually very well placed to be the Asian energy hub. Singapore has had 11 years of a very successful electricity spot market in NEMS. It will have the first Asian electricity futures market. Singapore is very well interconnected. There's gas pipelines going north and south. There's also a power interconnector that's currently not used that much going north into Malaysia. It is thus central in the electricity and also in the gas networks of Southeast Asia. Singapore also has just opened a large LNG terminal, which has third-party access, can accommodate spot trading, can accommodate break bulk business models, and can accommodate reloading, which is a very important feature. It's just not an import terminal. It can be used for all kinds of trading purposes. Singapore, as you know, is the largest bunkering port, and it's an oil hub, and it has the other usual ingredients that a successful financial trading hub needs. So it has a hands-off government approach, it has a largely deregulated wholesale energy market, and it has a good supply of balance and demand. Therefore, electricity is central to the other energy commodities in Singapore. It's connected to gas, pipeline gas, it's connected to oil through the indexations, and it's also connected to spot LNG prices. So electricity is actually a very important market in the energy market liberalization. I've also brought along the product specs. I don't think we need to go through all of this. I'd like to reiterate the 9 quarters that we will offer. The small size, which is 0.5 megawatts. And everything else, I think you will receive the pack in electronic form. So you can read through these details at that point. All of this, of course, is still subject to MAS approval, which is the financial market regulator here. So it's not final, but we expect that we will have a successful launch of this 1st of October this year. With that, I'd like to invite questions, if there are any.
And my question is, since Singapore power market is one of the successful, is it also possible for the small consumers, like in residential sector, to choose what utility should get their services from? By the way, my name is Salah Alawaji from Saudi Arabia.
Yes, so Singapore has partial retail liberalization, and it will be opening up the market further. I think it has opened up in April and dropped the threshold slightly, and there's another threshold dropping this year. And eventually we will have full retail liberalization. So the household consumers will eventually be able to choose their energy supplier, and those energy suppliers will make use of this market. So far, it's only the small to medium-sized enterprises that are large enough in terms of consumption to use this market. But the EMA, the physical market regulator, is gradually dropping the threshold above which you can choose.
How does that change the landscape for the 5 market makers or the power generators? Previously, there's vesting and non-vesting contracts. With this coming in, will that change the demand risk? Is the earnings visibility or revenue visibility higher for them, for example? Can you give us some color on the side of the power generators? Thanks.
Yes. So you're right. We have a vesting contract scheme in Singapore that is used to control market power, essentially. It's a market power curbing tool. And it obliges the generators to sell certain parts of their production volume at regulated prices into the market. And this vesting volume is gradually reduced over time. EMAs are setting the vesting volumes regularly, and this vesting volume has decreased over time, and EMA was able to decrease it over time because the market power isn't that important anymore. So actually, it's the other way around, the way I see it. The market risk for these generators is increasing because the vesting contract volume is decreasing, and this market actually is a good tool to now manage this risk that they have, this new risk. And I think that's why they're also keen to participate in this. There's no further questions. Thank you very much for your attention, and I wish you an enjoyable day at the conference. Thank you very much.